Am I going to get a $5,000 check from Elon Musk?
So, if you are cutting spending, which is a good thing in my book anyway. I like when governments cut spending. I generally think that when governments spend money, you get 50 cents back for every dollar. But governments cutting spending generally is a good thing.
Agreed.
The news story yesterday, or maybe it was over the weekend, that all Americans are going to receive a check for $5,000. Everybody should be excited about that on the surface, right? Getting a check for $5,000, nobody's going to be upset about that.
No.
The question is okay, well, why are we cutting government spending in the first place? Because our government is probably spending a little bit more than they should be, more than they're taking in, and that's called a deficit, right? We've got a really large deficit. We can continue to add to it every single year. So if we come up with a reduction in government spending and we distribute that out, we haven't changed the deficit, right? Deficit is still on the same track as it would have been if you didn't cut any of the spending, but you didn't send any of the checks out. And so you get stimulus because you're providing these $5,000 checks. Everybody's happy about it, much like you were with COVID, except that instead of this being money printing stimulus, it's just kind of another way of transfer payment stimulus, right? So you still have the deficit issue, but now you've got more money in the economy, which stimulates growth. So not as bad as printing, because it shouldn't necessarily be inflationary. But it's not, it's not like we've found an extra $5,000 per person and our deficit is also shrinking. Does that make sense?
It does make sense. Didn't something like this, it might be a little bit different, but I remember Bill Clinton in his final administration, he issued checks and he balanced the budget. How is that different than what's happening now?
Well, I don't think we've balanced the budget yet, right? So the checks are coming before the balancing. Maybe there's a difference there. I'm a little bit too young to have known what happened with the tax situation.
I'm sure.
But you yourself, I'm sure you can remember it vividly. It's been a long time since we've had a balanced budget. And it took a internet bubble, the creation of a completely new way of interacting, of humans interacting with humans, businesses interacting with other businesses and with humans. It took a completely new way of that dynamic to occur, to actually come up with enough growth to create enough tax revenue to come up with a balanced budget. I don't think it stayed balanced for very long.
No,
right?
It did not.
Bubble
it exploded.
burst, tax bubble burst, the internet bubble burst, and we were left with an unbalanced budget again fairly quickly. But we glimpsed it, right?
So just to kind of summarize what we're looking at today, it's that the budgets remain the same. We just are not allocating the dollars toward government spending. We're refunding it back to the taxpayer.
Well, I think maybe just a quick correction there. I think the budget is coming down.
Okay.
Right, but if you reduce the budget by a certain amount, let's just say it's $5,000 per taxpayer.
Okay.
But then you send that money all back to the taxpayers, the amount of gap in terms of your revenue versus what you spend has not changed, right? The aggregate spending has come down, but because you gave that money back to the taxpayers, your revenue came down by a commensurate amount.
Right, because you're not servicing the debt that's there. It's just going back to the taxpayer.
Yeah, so you have the same gap, but everybody feels better, which isn't necessarily a bad thing.
Fair point. Yeah. Psychologically, I'd feel better with $5,000.
Yeah, I'm smiling. This is a podcast, but it should be video. I am smiling when I get that $5,000 check. I'm putting it all on the birds for next year's Super Bowl.
Is that what you're doing?
Oh yeah, it's great odds, man. Great odds. Welcome back to the Ask Avidian podcast. Joined again with Robert Palmer, our head of financial planning. I'm Jake Borbidge, chief investment officer here at Avidian Wealth Solutions. A couple topics on the docket today. We're going to start with, I think a lot of this is going to be around taxes, around tax planning. The first one let's talk about is estate taxes and something that is, estate planning, something that is very near and dear to your heart, Robert. One thing that I read a couple times over the last week is that, one of the objectives of the Trump administration is to eliminate the cap on estate wealth transfer or the size of an estate that you can pass on tax-free to your heirs, right? Is that what you're reading too?
Yes, that is what I'm reading. There's a heavy focus on farmland owners. So people that service farmlands, typically they are, connected to the government because there's subsidies there. But more importantly, they have a really big problem transferring the farmland from one generation to the next, and they're directly providing for the food and ultimately servicing the food consumption of the nation. But when you can't transfer the property without going out of pocket because you're losing 40 cents on every dollar, now all of a sudden they have to sell the farmland. And you get people that are getting enticed by things like windmill farm building, right? So they need land to build windmills. And they will be approached and say, hey, you can't afford the estate tax. You need to sell some of this land. We will buy it from you. So more of the farmland is being dedicated to things like that as opposed to growing food, and that could potentially cause a food scarcity issue moving forward with the current trend that we're on.
So Old MacDonald has a farm.
Mm-hmm.
Old MacDonald dies.
Yep.
E-I-E-I-O, he has to put a bunch of windmills on his farm.
He owes tax. E-I-E-I-O tax.
E-I-E-I owes some tax.
There you go.
Windmill company says, hey, we'll fix your tax problem with a bunch of windmills.
Exactly.
But the windmills take away farmable acreage.
Yep.
Is that the idea? And then we all go hungry?
That's exactly right.
Okay. I don't like that outcome. So the I guess the news stories that we're reading about eliminating that cap on estate taxes, right? That would be a great option for the farmer who has a large, swath of land, but has no interest in selling it, no interest in developing it, and for the American people that like to eat food every day, they have a vested interest in him keeping that land intact, right?
Right.
If it goes to multifamily development, that's just less food that we can put on our tables, more and likely a higher price that we would have to pay for the food that we buy. So in the elimination of this this tax or this cap on estate tax transfer, estate tax, overall cap, is it limited to farmers, or is that's who it's intended to help?
That is the most attractive selling point from a legislative standpoint.
Okay.
So if you talk about food scarcity and farmers, that is more digestible to the public than saying there's
food is very digestible to the public.
Very digestible, yes. But
most foods.
That is more palpable or more tolerable from an elimination standpoint argument than billionaires should not pay estate taxes, right?
Yep.
So there are two sides of this. Do you create a narrow exception for people that own farmland, which has its own conflicts, by the way? It's not just the little farmer trying to protect his land. There's also, someone like Bill Gates who owns a ton of farmland. Now he can escape estate taxes by just buying up farmland. The point is that this is a complex issue, and there's a potential for loopholes where people can kind of exploit them and avoid estate taxes. And that's not something the public is overly in favor of.
Okay.
They don't believe people with hundreds of billions of dollars should be able to transfer that wealth to the next generation with no tax impact. They think that that's kind of a crazy, outlandish statement. And I would argue, yeah, that kind of makes sense. I get it. If someone's got $300 billion and they're not paying any tax and that money goes to the next gen, one thing that I've seen time and time again is that second gen, they're not operating the company, or the business interest. They're usually just spending it down.
Yep.
So,
okay.
Yeah.
Okay. Very negative outlook on the future of America from Robert Palmer and the youth that are inheriting all the baby boomer wealth. So let's just take a quick pivot and a little bit of a statement of where we're at today. So
yes.
I know we've talked about this in prior podcasts. Right now, Congress doesn't have to do anything, and there's going to be changes that happen. Right?
Yeah, so just to outline it, right now you're looking at a personal estate tax exemption of around $13.99 million, and I'm just going to round up to $14 million to make it easy. And so if you have two people that are married, you can protect up to $28 million. All of these numbers are being cut directly in half by the end of this year unless legislation changes. So basically what's going to happen is the Republicans are going to start pushing legislation now to try to address that as they revamp the TCJA, which is really at the core of this whole legislative process, because that's what expanded the tax brackets, that's what expanded the estate tax threshold, all those things. So if you look at where we are today and where we're going, it's actually kind of funny because when you start hearing pitches like we're going to eliminate income tax or we're going to and just subsidize that with tariffs or we're going to eliminate the estate tax, my first thought is, oh my God, amazing. More money in my pocket. Then I realized my entire job is dependent on there being an income tax and an estate tax to try to work around, and I got struck with fear from a job security standpoint. As it is now, it doesn't look like either of those are necessarily on the chopping block, but there is a push by several senators and House representatives to completely eliminate the inheritance tax, which, by the way, just so everyone's on the same page, when people talk about inheritance tax, estate tax, they typically are talking about the same thing. What we are talking about is the estate tax from a federal standpoint. not from a state standpoint. That's important to distinguish because federal is different from state, and you could potentially get slammed with both depending on where you live. So we are only focusing on the federal government.
Okay.
That's
Got
about
it.
where we are and where we're headed.
Okay, so no action means that the limit gets cut down basically
half.
by half,
Yep.
right? Some action could be eliminating the cap completely, and there is no more inheritance tax, no more estate tax.
Correct.
Some action could be we're going to keep it where it is. Some action could be we're going to keep it, where it is, but we're going to increase it by some amount that accounts for inflation. Since the last time that we, had this limit put in place, which was I think maybe 7 or 8 years ago. Is that right?
Yes, that's right. They're also considering potentially putting the GST generational skip tax on the chopping block as well.
Okay.
So they could keep the estate tax and eliminate the ability to potentially gift to a generation that skips the next generation,
Okay.
Which is a very interesting concept.
So we're in the business of coming up with solutions for our clients. Let's help Congress out here, right?
Yep.
If we are looking to get the best of all worlds, where we want to keep Robert employed, so we don't want to eliminate this completely, and we don't want to upset, the masses and create the impression that billionaires will never pay taxes, right? So so let's take that one, off the table. That I think is a kind of an outlier scenario.
Sure.
We don't want it to get cut in half, right? Because we've been doing a lot of planning, and we want to make sure that that planning is still intact and there's no disruption there. And for the families that have planned for that as well, right? There's no disruptions to that. But we want to make sure that we address the farmers, right? We don't want the farmers to be left out in the cold. We want them to be able to produce food. Is a reasonable solution to look at, okay, what farmland is worth today? How much is it going to increase? Does farmland even kind of stay the same in terms of valuation? So when it's passed on, it doesn't necessarily have this huge markup. Is there a nominal value? Maybe it's instead of 28, it's $50 million, where 95% of the farmers they would pass under that threshold. They'd be able to pass their farmland on. We don't have this, huge increase or elimination of estate tax or inheritance tax completely, and you lose your job. I mean, would that kind of satisfy the majority of, I guess, arguments or the majority of stakeholders in this situation?
I think you have to get a little creative with the intent behind the ownership of the farmland. So, for example, if you have a multi-generational farmland where it's owned from father to son to son to son to son to son, or daughter and daughter and daughter, so on and so forth.
Yep.
There's a clear intent for that land to continue being farmland, and it was purchased as farmland. It's being used for farmland purposes, and that in and of itself could probably be a reasonable basis to allow for an exception when it comes to that. But if you have someone like a Bill Gates that comes in and buys a bunch of farmland, you don't want them essentially just parking a bunch of money in real estate and effectively avoiding the estate tax.
What if
on
he
that
farms
portion.
the land, though?
Well, then,
Farmer Bill, come on.
if he farms the land and there's
all good, right?
Then I would assume it's all good at that point. But there needs to be a legitimate farming process, and then it becomes, okay, well, how do you vet that? You'd have to cross-reference that with probably tax returns from the IRS to see what's being deducted, what's being spent on, and all that stuff. So it gets complicated from an oversight perspective, because you and I can theorize about all these creative ways that we can kind of carve out exceptions from the estate tax and protect our food security, but at the same time, how do we provide the oversight to ensure that it gets enacted?
Yeah, and what we really don't want is we don't want a bunch of farmers having to liquidate their holdings and Bill Gates buying them all and then taking them out of the food supply because he wants to put solar panels on all those properties, right? That is exactly what we're trying to avoid.
Or even worse, we have to give back our $5,000 checks that we're supposed to get in order to pay for the oversight committee.
That is not happening. That check is getting cashed the day it hits the mailbox. Okay, let's move on. Let's switch topics. Also, another tax topic that I think is interesting, and also talking about loopholes, the carried interest loophole.
Oh, yes.
Is that what it's referred to, the carried interest loophole?
That's how I hear it on the TV.
Okay. And so there is a rule, or I guess a loophole, a rule, however you want to describe it, that, for the private equity community, right? Investors that are general partners that manage private equity funds or that make private equity investments on behalf of shareholders, most of their income comes in the form of what's called carried interest, right? And that is basically a return that's generated for a well-performing investment or well-performing portfolio investments that is paid to the selector of those investments, the portfolio manager, the general partners, the operators of those funds, right? They get paid in what's called carried interest.
Right.
Carried interest is treated from a tax perspective as capital gains tax.
Yep.
And the issue, or I guess the hot point is, number one, President Trump has indicated that he's going to look to close that loophole. The issue that comes up is if you are somebody that earns a lot of carried interest, most of your income is being taxed at capital gains, whereas the rest of America, whether you're waiting tables, you're doing brain surgery, most of your income is being taxed as ordinary income.
Correct.
And there's a big difference there. Think
Huge.
about 20% tax versus 40% tax, right?
That's right.
So I'll set it up there. I mean, what are your thoughts initially on this?
Yeah, I've been trying to figure out the rationale for it, and I kind of get it, right? The general partners are assuming a lot of risk when they go into these investments, and they really have to outperform in order to maximize the carried interest that they could potentially take home.
Okay.
And so there is an argument that they are invested the same way any other investor is, so the gains on it should be long-term capital gains. And also, you want to incentivize investment. You want these good operators on these projects to get these things done, because sometimes it's not just about making money. It's about building homes and resources for communities. Like, that's the byproduct of a lot of these private equity interests. So that's one side of the argument. The other side of the argument, as you pointed out, is everyone else who's getting income from their job is getting taxed at the highest effective rate.
Does the brain surgeon who's splitting your head open and lobotomizing you, he's not taking any less risk than somebody on the investing side, right?
That's right.
He's definitely taking risk of
He's
getting
the
sued.
general partner inside your cranium at that point.
Exactly. So I mean, it's not necessarily a question of risk. There is a question of return alignment, right? You want the people managing your money to be aligned, their interest to be aligned with your interests, definitely, and you want them to be long-term investors. So incentivizing them to load their returns based on the back end and based on results. I mean, that, I think, from an investments perspective, makes a lot of sense. That doesn't get into the fairness side of things. Typically, when I hear a politician talking about fairness, I mean, the first thing it goes back to is President Biden talking about paying your fair share. I heard that a number of different times.
Yes.
When I hear the word fairness from a politician, it typically, to me, means you have something I want and I'm going to try to take it. And so that's typically what political fairness means. But I think fairness is something that's really hard to get your head around. But that's the I guess the push behind this is that having a large piece of your income be taxed at capital gains is not necessarily fair,
right?
Especially if it's your income, right? What you're producing from the fruits of your labor. Passive investors, different story, right? 401ks, all that kind of stuff, tax deferred. Capital gains tax makes sense there, and that's something that everybody can participate in. There's a lot of individuals that work for public companies and are also paid in stock, and they're incentivized to increase the returns of that stock over time through their own efforts, and it helps align employees with the long-term incentives or the long-term results of a company. But typically, when employees receive stock, they pay ordinary income when the stock is awarded. So there's a cost basis.
Yep.
You pay the ordinary income tax on that cost basis. Maybe it's awarded at current value. Maybe there's a slight discount to current value. And then you can hold that stock. If the stock appreciates over time and you sell it, you pay capital gains on that increase in value, right? And so that, I think, is something that, again, as an olive branch to somebody that participates with most of their income coming through carried interest, that could be an olive branch that, could be extended. Hey, there's a cost basis here. The ordinary income tax, maybe that only applies to the cost basis. And that, for a lot of private equity investments is very low versus the overall result when they sell companies, right? You pay an ordinary income on a small piece of that, but your upside is still taxed at a fairly low rate.
Yep.
I was kind of thinking, okay, well, this has been tried many times, right? Closing this loophole has been tried many times. I think there's a lot of, political lobby behind keeping the loophole open. There's a lot of money behind that.
I also think there's some behavioral psychology going on here in terms of, like, we talk about this in financial planning all the time when we're engaging clients.
Okay.
But there's something called an anchor bias. You have these people that are high-functioning operators that are accustomed to getting paid a certain amount. And if you start reducing that, is that going to reduce the amount of high-quality operators we have? Is that going to diminish the quality of the final product? That's what the pushback would be from a psychological standpoint. Is like, no, I've been doing this work this whole time. This is what I got paid. This is what I'm worth. And now you're telling me I'm worth less. you know, and so of course there's going to be some backlash.
It hurts, right? If you've been cashing those checks, if you've been collecting that carried interest, and now you're hitting a whole different tax bracket, I mean, that definitely hurts. It bites into your lifestyle.
Absolutely.
And again, it's more money sent to the government. And what we said earlier in the call is, a dollar to the government comes back in 50 cents of actual value. So whether that, increases overall productivity for the country is debatable.
Or a one-time $5,000 check.
Yeah. I love that idea. We'll keep coming back to that. I think it's worth unpacking though, like why is this coming up now as opposed to, not last year? I mean, Biden could have tried to close this. He may have tried to close this. I think he actually did try to close it early in his presidency. We talk about private markets a lot on the investment committee. We talk about it with our advisors a lot. We've spoken about private markets on this podcast. And I think an interesting dynamic that I'm sure President Trump is aware of. He's got a lot of really intelligent investors in his cabinet providing him advice, is the number of transactions in the private equity marketplace has been subdued over the last couple of years. Mm-hmm. And to think about that another way, there's a lot of capital that is accumulating in terms of value where carried interest has not been realized yet. So think about a company that was invested in by a private equity investor, call it 5 years ago, maybe even longer than that. 2024, 2023 would have been a good year in terms of time, would have been an optimal year to liquidate that company. However, interest rates were higher, capital markets were not functioning, kind of in a normal way. The IPO door was very narrow and very difficult to get through. And so the number of transactions in the private space has been subdued 2023 and 2024, which means a lot of carried interest, a lot of upside on those private companies has not been realized, and there's been zero tax paid on it. If you think about it another way, 2025 could be a banner year for realization of carried interest. So anybody, a deal maker like Private Trump, is fully aware of this. He understands that the next 4 years may be really, really significant years for realization of this carried interest, making it, crystallizing it, and then it being taxed. And so if you understand that dynamic, you may understand that if you're able to get an incrementally higher percentage of that revenue, or of those of that income as it's realized, that would be a substantial boost to tax revenues, right? So I think there's an interesting timing component here that number one, it supports some of our investment thesis that transactions are going to be higher over the next 4 years than they have been over the last 4 years.
Why do you think that they'd be higher? Just to kind of break that out. I know there's been a lot of talk about deregulation, monetary policy becoming a little more flexible, but why do you think deal flow is going to get better?
So I think number one is that, it's kind of like a pig in a pipeline, right? So you can only slow down deal flow so much, and then transactions have to happen. Maybe they don't happen at the ideal price that you wanted them to, but if you can't liquidate, or if you can't, get liquidity in your private funds, then you can't start on your next private fund. And so there's a strong incentive for, the private equity community to make transactions happen, not at any price, but at a price that might not be, kind of the perfect price, right? So deal volume is likely to increase just because it's been low over the last couple of years. One of the reasons it's been low is interest rates. I don't think interest rates are coming down substantially anytime soon, so that's not necessarily changing. But the exit path of IPO has been subdued over the last couple of years, and deregulation could definitely open that door much wider over the next couple of years, right? So we've already seen some changes in kind of DOL leadership. That's where kind of that IPO market, or that IPO door, can get squeezed, closed, or just squeezed so it's a very narrow crack. Deal making in terms of public companies buying other public companies, to the extent that any of that stuff loosens up, you'll see more deal making. So I think that aligns with the desire to collect more a larger portion of that income, but it also aligns with our thesis from private markets, which is generally higher volume of transactions is generally supportive of private markets. It means that funds that haven't been able to return capital can. Investors that have been waiting on liquidity will receive it. They can make new investments. Other companies can be funded, right? So it kind of tends to lift all boats, but it does result in taxable revenue, right? So that there's obviously that trade-off there. So anyway, that part of it is somewhat exciting. Obviously, the jury's still out on whether those transactions are going to happen, where the IPO market is going to really kind of kick off. But from what we hear, just kind of whisper numbers, things that, are not public markets info, it does seem like that is the direction things are heading. So that's definitely exciting. Let's switch topics one more time, unless anything else on that.
No, I think you made great points. We got deregulation coming in. Deal flow is likely to increase. Trump wants to essentially close the carried interest loophole to collect on that additional deal flow. Because he'd be getting a larger portion of the tax revenue by making it tax that ordinary income instead of long-term cap gains. And given that he's cutting back on spending and trying to do something with the budget in connection with that deficit you referenced, that makes a lot of sense.
Okay, so let's circle back to Doge, right? We talked about the checks. Doge is going to be sending us checks.
The government agency, not the cryptocurrency.
Well, yeah, but interestingly, is it possible for the government to send us those $5,000 checks in Doge the coin, right? Doge the agency sends Doge the coin. That would definitely result in an increase in the value of Doge, right? So you got to anyway.
Are you telling me the government could hand me an asset instead of some paper that they print? I don't think that's going to happen.
Now that is, I don't think that's in the cards. It would be ironic if they said we're going to send you a $5,000 check, but it is in the cryptocurrency markets, and so kind of hard to get access to that and hard to spend. But I don't necessarily think that's going to happen. However, the Department of Government Efficiency, that Doge, right? There was an interesting article, more of a quote than an article, that came out where Elon Musk was intimating that if the Department of Government Efficiency is highly effective in reducing government spending, that it could be stimulative to the economy in the way that borrowing rates could decline. Mm-hmm. And to me, it's a bit of a leap. Did you read that same point? I mean, what's your take on that?
I did. It was talking about basically banking flexibility and also inflationary impact that a reduced government spending bill could have, or a reduced government spending policy could have.
Yeah. So let's think about what factors influence the level of interest rates. And we won't talk about credit spreads. We won't talk about any of this stuff, just the yield curve, or the rates that are required to give the government money, to basically loan the government money, which right now, just north of 4% for cash, a little higher than that on the 10-year, even still higher than that on the 30-year, but still in that kind of, we'll call it somewhere 4 to 5% will cover the entirety of the yield curve today. Most companies, when they borrow, they're not borrowing with cash. They're borrowing with cash plus some spread, or they're fixing maturity, maybe 5 years out. So they're borrowing at some level that's higher than the yield on a 5-year Treasury note. The things that influence Treasury, especially going out longer term, obviously one is the credit worthiness of the U.S. government, right?
Yes.
But it as so far as the government can print money to pay its debts, which is not something that we've heard anybody dispute. Even 5 years from now, the government's still going to be able to print money to pay its debts. And so the odds that you don't get paid back on that 5-year loan that you give to the government are virtually zero, although you'll typically, you'll hear some speculation for and against, okay, well, maybe they're going to not pay their debts, maybe they will. I don't think that's really part of what's in the cards. So that's one thing that influences the level of interest rates, right? A second thing is just kind of the expectations around growth and the expectations around future cash rates. So a good proxy for what cash rates are going to do in the future is look at where future interest rates are today. So a good proxy for, tomorrow's cash rate is what the yield on tomorrow's bonds are, and just kind of back that into today. And so what the markets are telling us now is that the return on cash is going to be fairly sticky, right? The yield curve is positively sloped. And the reason I think that it's positively sloped, there's a couple things at play.
What does that mean? Just to kind of break that down real quick.
Good question. So positively sloped, basic, way to think about that is if the yield on a 2-year bond is lower than the yield on a 10-year bond, that means you get a higher overall nominal return for loaning your money to the government for a longer period of time. And that is normal, right? That has not been something that we've experienced over the last, call it 2 or 3 years.
It was inverted, right?
It was inverted, yeah, for a really long period of time. I think about 2 years it was inverted, which meant that if you lent the money to the government for 10 years, you got a lower return than if you if you lent it for 2 years, right, on an annual basis. That's atypical, right? We're in a more normal environment. We're not getting a big additional return for lending for longer periods of time, but we're getting something, right? About 50 basis points, I think, is where we're at right now. So what influences that, we'll call it the 10-year point, right? That longer term point on the yield curve. Growth is one thing that influences it. Inflation or longer term inflation expectations are something that influence it. And typically, a good rule of thumb is, okay, the yield on the 10-year should be some proxy of, the level of inflation, the level of real growth expectations, and then some, risk parameter, risk premium, right? And so if you said long-term inflation expectations are, should be around that 2 to 3%. Long-term real growth expectations for the U.S. economy, again, around that 2 to 3%, you kind of start factoring to something that sounds like a 5% yield on a 10-year, which is pretty close to where we're at today. I think we're at about 4.5, 4.75, maybe, depending on the day.
Yeah.
Is that right?
Yeah, that's about right. So I just wanted to circle back on something just so I understand, because I've read a lot of these articles, like government's going to keep printing money. Printing money is bad for inflation. But I've also read some counterpieces where when you print money, if it actually is producing substantial growth and is reinvesting back in things like infrastructure and businesses, it doesn't have a super high inflationary impact as long as GDP remains positive. Is that a gross oversimplification?
I wouldn't call it a gross oversimplification, but you're definitely doing some simplification there. And I think there's different economic schools of thought when it comes to, does the printing of money create inflation, or does the printing of money reflect inflation that's already been created? I tend to be more of a monetarist, which means I think printing money does inject inflationary influences into the economy. It's more dollars chasing after the same level of goods. So if growth is flat or zero and you have growth in money, right? Now you have more dollars chasing the same basket of goods.
Positive inflation.
Positive inflation, yes. If you have growth in money, which is printing of money, but you have growth in the basket of goods or GDP, and those are kind of similar, right? Or maybe one's a little bit higher than the other. That's kind of normal. I don't think that's very inflationary. However, what we saw, in 2021, 2022 was the growth in money, right, due to printing, due to sending out stimulus checks, was substantially higher than the growth in GDP, which we were actually kind of going into a short-lived recession. And that is inflationary, right? Clear and plain simple. And we have a really good observed data point to show that money growth created inflation.
The price of eggs.
The price of eggs, which is, again, a lot of things go into it. Bird flu, shipping costs, oil, all that kind of stuff factors into the price of eggs.
Of course.
But the price of eggs is high, and I like to eat eggs. They're a good source of protein, so I want that price to come down. So let's get back to where did we start? I'm kind of losing track here. We're getting off on a tangent.
Yes, we were talking about how if we cut government spending, that could have a positive impact in the regulatory environment and the borrowing environment.
Yeah, so if you cut government spending, and then that is so less government spending tends to be anti-stimulative, right? It's positive government spending is stimulative to the economy, even if it's not super efficient. If you have reduced government spending, you're removing stimulus from the economy. To the extent that removes or reduces demand for any goods, services, or aggregate baskets of goods and services, that is anti-inflationary. I wouldn't necessarily go so far as to say it's deflationary, but it would suppress inflation.
What's the difference between anti-inflationary and deflationary?
I think it's just two words that I made up.
Okay.
But deflationary means
like
prices. Yeah, deflationary means prices are coming down. Anti-inflationary means that prices are probably stable and still rising, but slowly.
More neutral, I guess. More
neutral, yeah. Okay. Something that we can be comfortable with, where the price of eggs isn't going to go from $3 to $10 for a dozen over the course of 6 months. So, to the extent that we have reduced government spending in a way that reduces, demand, and that suppresses inflation. Inflation is one of the things that influences long-term yields on the Treasury, right? So, to the extent that suppresses that long-term inflation expectation, your 10-year yield comes down. Maybe your 5-year yield comes down. Maybe the whole yield curve reduces somewhat. If you're a corporation, you're trying to borrow money there's always going to be a premium above that yield curve. So if that yield curve gets suppressed, corporations can borrow money at lower rates. This is the very long leap that we're going to take to get to Mr. Musk's statement and validating that Doge can actually stimulate the economy by making it cheaper to borrow money, right? So Doge cuts government spending reduces demand. Reduction in demand reduces your interest rate expectations. Lower interest rates allow companies to borrow at lower levels, increases the amount of earnings that are kept by the equity holders, and that is stimulative of spending because your cost of capital is lower.
Look at all those dominoes falling right into place.
Right into place.
Perfectly.
Right into place. that would be a lot to capture in a tweet, right? So we unpack the tweet here on Ask Avidian.
Well, Jake, this has been illuminating, and it seems like the environment is far more complex than the news headlines would allow us to understand, and probably rightfully so, because I think my head would explode if I started seeing all these dominoes on the screen every single day. But I'm really glad you're here to kind of break it down for us and get a better understanding of what this macro environment is and how the government intends to address things moving forward and where potential opportunities are and some things to look out for.
Well, thanks a lot, Robert. If you want to take this discussion any further, come check us out on avidianwealth.com.
I will.